Risk management is one of the most important things in trading. You can't have proper risk management without two things. One, a actual winning model, and two, strong psychology in the markets. I want to talk a little bit about my first point, saying you need a winning model to have good risk management. When I mean a winning model, I don't mean 50% or more. I mean you need to win enough times that when you run into losing streaks, you don't blow your account. Before I found the model that I'm currently using, I was trading a less profitable model and I was struggling with risk management. Not because I just wasn't a good trader, because I was losing too many times and my psychology wasn't up to par and I kept chasing my losses and over leveraging. There's to a point where you need to know enough about price action to where the next step to bring you to the next level in trading is risk management. When I got my first payout, I didn't really need to focus on risk management because I had a winning model. But then after my first payout, I really focused on risk management and I had a few losing trades. Without risk management, that would have blown my account. There's 3 steps in trading. ICT says yearning, learning, and then earning. Yearning is passing your first account, losing the account, getting to your first payout is yearning. Learning is after your first payout, seeing what it's really like as a real profitable trader and how do you stay consistent. Earning is when you found your consistent model, you found your consistent risk management model, and you have good psychology where you can constantly repeat the same thing week over week and show consistent profits in the markets. The current risk management model that I use isn't a really strict model, but I limit how much I risk, not to my account size, but to how much my psychology can take. For example, if I have a $50,000 funded account, I'm only going to risk $150 per trade, because if I lose, let's say 2 trades, that's only $300, and I'm strong enough to look at that and get off of the charts. But if I was risking $250 to $300 a trade and I lost 2, and I look at my P&L and it's negative 500, I'd have the feeling of I need to make that back. Yes, obviously that'll come in time where I can risk more and not have bad psychology, but you need to adapt to the type of trader that you are. Not just your equity, but how well are you going to be able to bounce back from your constant losses? How well are you going to be able to manage your losses? The newer you are to trading, the less you should risk. The majority of traders go from risking a lot to a little to a lot. When I first started trading funded accounts, I was risking around 1 to 2% per trade. Now I'm risking 0.25% per trade. Guess which one I'm more profitable in? Risking 0.25% per trade. Not because I can't catch entries if I risk more, but because I can't manage my risk properly without having bad thoughts when I risk more. I want to jump into the charts and talk a little bit about risk to reward and how should you target risk to reward to match your risk management. So there are a few factors on risk management. I find too many people on Twitter are staying stuck with, just 2RR or 3RR and having a set RR amount to manage their trades. And I think that is not correct. If it works for you, obviously keep doing it, but I don't think this is the best way to target risk management. And let me explain. So what I drew out here is this is the draw on liquidity, the equal lows on the day. So what I drew out here is the draw on liquidity and what 2RR in the trade is. This is our target. This is where price is going to go. And this is where traders take profit if they have a set RR. Now, sometimes it could be different. It could be the complete opposite and you actually lose your trade because you're too focused on your risk to reward ratio, or you miss out on profits because you're too focused on your risk to reward ratio. Now, if you don't want to just go off of draw on liquidity and you do really want to focus on risk to reward, you can also do this while getting the extra profits. One of the best pieces of advice I was told was to trade the charts, the actual markets, and get rid of money in the entry part. Now, one tactic I use with keeping RR in the picture and also utilizing my draw on liquidity is I take partials. I take partials at RR and then drag my stop loss to break even, holding the rest down to my draw on liquidity, giving me a little bit more profits. If that is your draw on liquidity and your analysis around this trade matches up and lines up with price going to take that draw on liquidity, why take your profits out early? Now, let's say this is the opposite and we have 2RR here, and that's the draw on liquidity. Now, traders will be too fixed on the RR aspect of the trade that they will lose out on profits and lose the trade because price will do this and then go back up and take their stop loss. Now, this is why actually reading price is super important, and doing this helped me get a lot more payouts. And that was, don't be greedy with your trades, but also be smart with your trades. Know when it's the right time to let your take profit ride and take your profits. A few factors you can use to see if you should hold for drawn liquidity, or at least let a few contracts ride out, is day of the week, time of day, what did the previous session do, is the trade high probability, and the 4 hour to 1 hour bias depending on how you entered. If everything is high probability and there's no reason for price to reverse on you, then bet on yourself and hold the trade. Don't hold it to some random point in oblivion that is a lot of money because you want to make that much. If you need $1,000 to pass your account, but the drawn liquidity is 700, don't drag it down to 1,000. That makes no sense. But if you have a valid reason to put your take profit somewhere based off of the trade that you took, utilize that. You don't even need 2 RR to be profitable. With proper risk management, you can have 1 RR. So don't get too focused on the risk to reward ratio aspect of trading, and really focus on price action. So that's risk management and psychology. I hope you guys found this video insightful, and I'll see you guys later.